Please stand by. Good morning, everyone, and thank you for joining us for today's Old Second Bancorp, Inc.'s fourth quarter 2019 earnings call. On the call today is Jim Eccher, CEO, Gary Collins, Vice Chairman, and the company's CFO, Brad Adams. I will start with a reminder that Old Second's comments today may contain forward-looking statements about the company's business, strategies, and prospects, which are based on management's existing expectations in the current economic environment. These statements are not a guarantee of future performance, and results may differ materially from those projected. Management would ask you to refer to the company's SEC filings for a full discussion of the company's risk factors. On today's call, we will also be discussing certain non-GAAP financial measures. These non-GAAP measures are described and reconciled to their GAAP counterparts in our earnings release, which is available on our website at oldsecond.com under the Investor Relations tab. Now I'll turn the call over to Jim Eccher. Please go ahead, sir.
Thank you. Good morning, and thank you for joining us today. I have several prepared opening remarks, and will give you my overview of the quarter and then turn it over to Brad for more additional details. I will then conclude with some summary thoughts and open up for questions after that. Net income for the quarter was $9.5 million, or 31 cents per diluted share in the fourth quarter. Earnings this quarter were negatively impacted by compression in the net interest margin that totaled 28 basis points from third quarter levels. The core net interest margin contracted a somewhat more modest 15 basis points, excluding the impacts of purchase accounting income on acquired loans recorded in the third quarter. This is a bit more than we were expecting, although still within the range we provided of 3 to 5 basis points for each Federal Reserve reduction in the overnight rate. Brad will provide some additional color on the margin in his prepared comments. Earning trends were positively impacted by a BOLI death benefit of $872,000 during the quarter. Absent these items, earnings trends were relatively stable and consistent with last quarter, though we did see mortgage banking results soften from a seasonal slowdown in the quarter. Returns on assets and equity continue to be very strong, driven by a still healthy net interest margin, solid expense control, sustained performance across our fee-based businesses, and a stable credit outlook. A high level of profitability has afforded us the ability to invest significantly in the future growth of the bank. In regards to the quarter specifically, total loans increased by $31 million from last quarter, with a strong level of originations mitigated by continuing payoff activity. Loan payoff activity accelerated every quarter in 2019, and we're hopeful the pace of payoffs will moderate in 2020. We've continued to be surprised by the level of payoff activity. However, loan pipelines remain healthy. The competition for credit in our market still remains very aggressive, both in terms of pricing and structure. And with the tailwinds provided by an expanding margin having lessened, we expect to increase efforts to grow the loan book and capitalize upon recent additions to our staff. We're optimistic we can achieve 5 to 7% loan growth in 2020, exclusive of any merger activity. Lastly, as it pertains to the loan book, yields on the portfolio declined substantially from last quarter due to the benefit of accelerated accretion from the early payoff from an acquired loan in the prior quarter. Total deposits bounced back nicely on both a period end and average basis, and growth here remains a key focus for us. Our net total transaction account activity has largely been stable, with declines primarily focused in higher cost relationships acquired in 2018. The loan-to-deposit ratio for the fourth quarter of 2019 remains unchanged at 91%. We believe we can remain at these levels in the near term, with loan growth funded by a mix of deposit growth and modest balance sheet optimization. We remain very comfortable with asset quality trends overall. Non-performing assets and classified loans increased modestly relative to last quarter, but remain well controlled. Overall, we remain very encouraged about our results in a number of areas, and Brad will provide additional color in his prepared comments.
Thank you, Jim. Net interest income declined by $1.6 million relative to last quarter, with about half of that decrease due to negative variances and accelerated accretion on acquired loans. Fee income suffered a bit as mortgage banking income returned to a more normalized level. The reported taxable equivalent margin decreased by 28 basis points, as Jim said, from last quarter, with about half of that contraction due to 15% paydowns in the acquired ABC portfolio during the prior quarter. A few additional basis points were lost on the margin due to the sale of the securities during the third quarter, though the trade in aggregate was a very good one with the subsequent movement in interest rates. Pricing movement on the liability side of the balance sheet has been limited to this point, though we should begin to see reductions in funding costs in the first quarter of 2020. Notably, margin trends in future periods will be impacted modestly by the adoption of CECL on January 1st, 2020, with a further reduction in accretable discount offset by movement into the allowance for credit losses. Equity levels will also be modestly impacted by the change. The overall increase in the level of credit loss reserves, currently estimated at a $4 to $6 million increase in the loss reserve, will be largely derived by the reclassification of purchase accounting credit discount into the loss reserve. As these loans mature, we will begin to see these reserve levels migrate down to levels not inconsistent with historical trends for us, given the relatively short duration nature of our loan portfolio. Our efforts in the coming quarters will be focused on quality loan growth and core funding, with the expectation of further modest contraction in margin trends going forward. The loan-to-deposit ratio leaves us well positioned, and we have ample flexibility both to continue the pursuit of growth while protecting our core deposit base. As Jim mentioned, it is likely we will seek to optimize the earning asset mix and fund future loan growth going forward through a mixture of deposit growth and earning asset optimization. Core margin trends in the future should be relatively stable with a modest negative bias, absent any movement in the Fed funds rate. Notably, we saw significant decreases in the LIBOR rate during the fourth quarter that were in excess of our expectations. We are incredibly sensitive to movements in LIBOR rate. Should it recover and start moving the other direction, obviously this guidance will prove conservative. Should it continue to trend downward, we would not do as well. Overall loan growth will become a much more important factor for us with the outlook for short-term rates having changed, but I believe we have a significant opportunity in front of us. On the fee income side, mortgage banking reflected a decline in gain on sale margins during the quarter and more modest pipelines. Although MSR valuations for the fourth quarter compared to the third quarter were more favorable. Trust and wealth management remained steady, and retail banking trends slowed modestly in both fees and card activity during the quarter. Expenses remain very well controlled, as you can see, with additional sales hires largely offset by seasonal factors during the first quarter, and continuing investments for future growth are largely baked into a run rate trends you have been seeing from us. With that, I'll turn the call back over to Jim.
Thanks, Brad. In closing, we remain encouraged with these trends and optimistic about the future. On an organic basis, operating leverage remains strong, and we are excited about the quality of talent added to the organization in the last 2 quarters. Profitability remains excellent, and we are pleased that the outlook for short-term rate movements has stabilized since we last spoke. Capitals continue to build significantly for our company, and though we remain very comfortable with the returns we are generating, we will be evaluating opportunities to return capital to the shareholders and reduce high-cost debt versus our outlook for opportunities to invest capital. 2019 overall was a very good year for us. 2020 will be more difficult if interest rates hold here or decline further. We are taking the steps to position ourselves well for either continued strength in the local economy or the possibility of a potential slowdown. We believe our credit underwriting has remained disciplined and our funding and capital position is strong. Overall, the team here has never been better, and I remain optimistic that opportunities are available to improve our footprint. The focus for us is on timing and making sure that we have access to the capital we need in order to take advantage. Periods of significant changes in the volatility of bank valuations make M&A more difficult in the community bank space, but things can change quickly on that front, especially as we move through what may well be a more difficult year for some banks. That concludes our prepared comments this morning, so I will turn it over to the moderator and open it up to questions.
Thank you, sir. And ladies and gentlemen, if you'd like to ask a question at this time, it is *1 on your touch-tone telephone. Please make sure your mute function is turned off to allow your signal to reach our equipment. Also, please pick up your handset so we can hear you clearly over the phone. Again, that's *1 at this time if you'd like to ask a question. We'll go first to Chris McGratty with KBW.
Hey, good morning, Jim. Hey, Rod.
Morning, Chris.
Could we maybe start on expenses? You guys have done a pretty good job keeping the expenses flat. In light of your comments on revenue growth being more of a challenge for the group, how do we think about the trajectory of expenses given what you're doing on the hiring front?
I think that given some momentum on the loan growth side, I don't think there's anything that aggressive needs to be done there. We had talked in the past at kind of a low single digit number on the expense growth line. We're watching things carefully relative to loan growth. I'd say that prepayments are still very highly elevated. We saw a number of significant prepayments during the fourth quarter. If that trend continues, we may need to get more aggressive on expenses, but for now we're still comfortable with the thinking for the year.
Okay, great. And then you talked about the balance sheet optimization. You guys have obviously done a lot of work on the balance sheet in the last couple of years. How do we think about if your loan growth, I think you said 5 to 7, should we be assuming earning asset growth trails that and the security book is flat down, or how do we think about that mix, Brett?
I at this point, given some positive momentum on the deposit side, I think that we can hold relatively steady on the securities portfolio. That would be our lever if deposit growth isn't there, to shrink that portfolio modestly. But again, our real exposure is to down short rates, and adding additional funding that does reprice with the short end of the curve is not something that I would shy away from at this point, given where we are in that cycle and what our overall positioning, based on just the character of what we are, which is an extremely well core funded community bank.
Got it. Great. And maybe just last one for you, Jim. You touched upon in your closing remarks the capital. How do we think about the ranking of the other priorities of returning capital and redeeming the debt? You talked about it last quarter, but obviously the rate outlook's gotten a little harder. Thanks.
Yeah, obviously we're focused internally on organic loan growth first, but we certainly are taking a very hard look at TRUP's redemption and reducing some of this high-cost debt. That is probably right at the top of the list.
Thanks.
We'll take our next question from David Long with Raymond James.
Good morning, everyone.
Hey, David, how are you?
Good. The pay-downs that you've been having, what are you baking into the pay-down levels for 2020 when you talk about a 5 to 7% loan growth outlook?
Yeah, that's been, David, that's been the challenge, obviously. In 2019, we saw pretty significant acceleration in pay-downs each and every quarter. Partially, the reason for that partially is the dynamics of our portfolio are changing. The duration's relatively short, but we had unusually very high pay-downs in the third and fourth quarter. So we do expect that to moderate, and it's hard to peg that because we're seeing a lot of clients sell properties that we didn't even really know about. So given the pace of loan originations, we're optimistic that's going to slow to more normalized levels in 2020.
Got it. Okay. And from an operating leverage perspective, can you guys put up positive operating leverage in 2020, even with the NIM challenges, or does the NIM, the headwinds from the NIM, make that too difficult at this point?
I think all we really need to see for positive operating leverage is for LIBOR to quit contracting relative to the overnight rate. The LIBOR rate has shown a great deal of compression during the fourth quarter and to a level that surprised me, to be honest. If that ceases, if it stabilizes, then I believe we can show operating leverage.
Got it. And then as it relates to CECL, I think, Fred, you made some comments about the purchase accounting. And did I hear right that you will move the credit marks out of the purchase loans into the reserve, meaning that you're considering the loans PCD at this point?
Yes. So overall, the reserve level should go up, like I said, $4 to $6 million. A significant portion of that, rather than being an adjustment to equity, will be an adjustment from the credit loss reserve on acquired loans. And the adjustment overall from an equity standpoint should be relatively small for us. Again, those loan books that have a short duration, i.e. more commercial bent, are not going to see the type of impact that residential and consumer balance sheets are going to see.
Got it. Appreciate the additional color there. Thanks, guys.
Yep.
And we'll go next to Evan Lyle with Janney.
Hey, good morning. I'm on the call for Brian Martin.
Okay.
First, appreciate the color on margin, and we're just kind of curious how you're thinking about the margin in 20 with a flat rate environment, and then possibly with forecasting one cut in the year.
Well, I don't think we're going to see one cut. If we see any cuts, we'll probably see a number of them.
Okay.
One cut doesn't make a whole lot of sense to me. I think that a stable rate environment, applying the methodology that nothing changes anywhere on the curve, and you take the steepening that we saw, I would feel pretty good about that. If you're talking about any rate cuts, that doesn't excite me in the slightest. I think loan growth can overcome one rate cut if that's been a scenario you want to talk about. But, in general, nothing changes. I think that we would lose a couple of basis points with CECL and delayed impacts of the LIBOR moves that have occurred, and I think we'd be relatively stable from that point.
Okay, awesome.
The challenge is in margin guidance is taking the rate moves that have happened, telling everybody they're static, and then accounting for the lagged effects of those rate moves that have occurred. In general, over a full cycle, irrespective of when quarter cutoffs are, we lose 3 to 5 for a rate cut. Doesn't always fit well within a quarter, but that is the overall impact.
Okay, yeah, no, appreciate that. And next, just talking about the people you hired in 19, can you just give a quick outlook about that, and then potential hires in 20, and just your outlook for that in the future?
Yeah, well, we obviously made a number of ads in the latter half of 2019, all season Chicago-based lenders, about 6 of them. But we've also added to the retail bank and our treasury group, so we feel real good about the talent we've added. A large portion of our loan growth in the fourth quarter came very late in the quarter too. So while our footings were up, we really didn't see much benefit of that in the margin. So we continue to be opportunistic on the new talent front. So if those opportunities come along, we will selectively continue to add.
Awesome. And just touching on the loan pipeline and the Chicago hires, it looks like last quarter most of your originations are coming from the Chicago market. Is that still fair to say in this quarter?
I would say yes.
Okay, awesome. And then just a housekeeping thing. Can you discuss how you're thinking about your provisioning in 20 under CECL?
As we said previously, it wouldn't expect it to be materially different than historical trends. The provision level with the adjustment itself will be higher given the size of the acquired loan portfolio, but from our ongoing origination standpoint, I doubt we'll see much of a difference.
All right, perfect. Yeah, that's all I have. Thank you for that color.
All right.
And again, ladies and gentlemen, if you do have a question, it's star one on your touch-tone telephone. Star one to ask a question at this time. We'll go next to Nathan Race with Piper Sandler.
Good morning. It's Bob on for Nate. How you doing?
Hey.
I wanted to touch on the $2.5 million in loans past 90 days that appeared this quarter. Could you provide some color on that, maybe the industry focus and collateral backup and what you guys expect from that going forward? Thank you.
Yeah, we had a couple just administrative past dues at the quarter. They weren't classified. We did see a moderate uptick in classifieds, but we expect to have those remediated in the first quarter of this year.
Okay, and then turning to kind of loan pricing, do you guys by chance have the weighted average rate on new production this quarter?
Yeah, this quarter it obviously fell off a little bit with LIBOR dropping, but we were in the mid to high fours on a weighted average yield.
And and that dropped. Is there how that compared to third quarter?
Yeah, we dropped about 30 to 40 basis points.
Okay, thanks. And then maybe could you provide a little color on the loan pricing dynamics you're seeing in the market right now, and maybe where the competition is coming from? Is it the larger guys, or is it the smaller community banks that are pushing the pricing?
Yeah, well, obviously in Chicago, we're seeing competition from the larger banks, and then in our more rural areas, the smaller community banks provide pretty competitive pressures there. But the primary growth engine for us has been in Chicago, so we're competing with the larger banks there.
Okay, thanks. I'll step back.
Thank you.
Mr. Eccher, there appears to be no further questions at this time. I'd like to turn the call back over to you for any closing comments.
Okay, thank you everyone for joining us this morning, and we look forward to speaking with you again next quarter. Goodbye.
Ladies and gentlemen, this does conclude today's teleconference. We appreciate your participation. You may disconnect your line at this time, and have a good day.